Good morning and welcome to FBN Forward Markets. My name is Brian Como. Today is the 21st of August. All right, let's get into what has happened in the futures markets over the weekend. Soybeans are up. They actually gapped higher and are up 22 and a half cents today at 13.75 and three quarter. Soybean oil is also catching a bid, up 1.4% at 60, almost 65 cents a pound. Soy meal is also up about 1.8% at $395.60 a short ton. Canola on the ICE exchange is up $9.90 at 810.40. We've got rapeseed in Europe at 474.50 and palm oil in Malaysia at 39.36 ringgit. Both of those are stronger over the weekend. On the grain side, we've got corn up 2 and three quarter cents at 4.95 and three quarter. The wheat markets are suffering a little bit. The soft wheat is down 4.5 at 6.34 and three quarter. Hard red winter wheat is down 9 and three quarter at $7.51. Spring wheat is down 6 and a quarter at $8.11. Oats down 2 and a quarter cents at $4.59. We got crude oil up about $1 a bushel, or $1 a barrel today, at 82.30 per barrel. The US dollar has faded a little bit down to 103.24. The Canadian dollar is up about 3/10 of a percentage point at 74 cents, just over 74 cents. Stock markets are getting a little bit of a bid this morning. The S&P is up about 3/10 of a percentage point at 43.98. NASDAQ is up about 6/10 of a percentage point at 14,829. And the Dow is up marginally at 34,623. All right, let's get into what is happening in the markets today. We've got soybeans surging on hot, dry weather. So Chicago soybeans rose for a fourth straight session on Monday to reach their highest in more than 3 weeks as hot, dry weather in the U.S. Midwest fueled concern over crop stress. There are a number of analysts that are seeing this dryness and are trimming soybean yields as a result. There may have been actually some adding to the soybean yields in the last couple of weeks as crop condition ratings were rising. That may be reversing now. The market is now awaiting USDA crop condition ratings from later today, and we also have the Pro Farmer Tour starting today, which generally generates some headlines that can cause some volatility in the markets as well. Here's what that chart looks like today. As you can see, there's a gap here in the chart. Let me get my trusty laser pointer out here. Nice gap here. I think that there's definitely opportunity for this to run up into this 1380 or even 14 to 1420 consolidation zone. This might be temporary, however. Weather-driven rallies tend to be more temporary. We'll talk about the fund positioning in a second here, but so we could see it test those previous highs. I think that's what we're looking at this point in time. Here's what the weather situation looks like right now in the U.S. Midwest. Not a lot of rain. This is the 5-day forecast issued this morning. Pretty dry. And here's what the heat. This is just even the heat high for tomorrow. Very high heat. We've got soybeans setting pods in the most vulnerable time of setting pods right now. Hence why the market is rallying so aggressively into this market. And, this heat carries through a number of days through this week. So a lot of stress on the soybean crop at this point. A little bit on the demand side, China's July soybean imports from U.S. tumble, Brazil shipments surge. So we're definitely seeing a shift in demand from U.S. origin to Brazil, as Brazil had a large crop. The U.S. has tight supplies. China's soybean imports from the U.S. tumbled 63% in July from a year earlier, while shipments from Brazil, which is its top supplier, surged 32%. Data showed on Sunday, spurred by a bumper crop and lower prices in Brazil or in Latin America overall. China is the world's top buyer of soybeans, which imported 142,150 metric tons of soybeans from the United States in July, which is down from 381,568 tons a year earlier. So a significant difference year over year. This isn't a huge time for Brazil to be buying U.S. soybeans, as the supplies in the U.S. tend to be at their shortest period right before harvest. So this generally is a time when they start buying a lot from Brazil. It's just that the shift is happening a little bit more aggressively than normal. The U.S. does remain China's second largest soybean supplier, accounting for about 32% of China's total soybean imports for this the first 7 months of this crop year. We're also seeing soybean oil reach previous highs as well. This is important because the share of the soybean crush, the soybean oil share has been rising as well. So now about 45% of the soybean crush makes the soybean crush. The oil makes up about 45% of the soybean crush, the value of the soybean crush. So oil is becoming a more important factor in the profitability of soybean crush. When oil rises, we tend to see profits, crushing margins rise, and conversely, we see soybeans rising as well. The other thing that happens with soybean oil is it helps other oil seeds as well. Canola oil is priced off of a basis of soybean oil, and this rise in soybean oil is also helping canola. Canola rise as well. So we are back at about $810 a metric ton for canola coming out of this weekend. And we are seeing some positive technicals as well, with a possible crossover of moving averages here as well. So overall, we're relatively bullish on most of the oil seeds, at least at this time. Corn's a little bit of a different story. We did see a rally because of the same weather pattern that's happening in the U.S., although it did fail to move above the 20-day moving average, which has been in decline since early July. So the market is definitely, and as you can see on this chart, it did gap higher as well, but filled the gap over the trading session. So that's not as positive a sign as what we're seeing in the oilseed markets for sure. And here's one of the reasons: funds are selling CBOT corn. They're also selling soybeans and wheat as well. As supply fears wane, speculators have ramped up their comfort with global corn supplies this month, though U.S. crop uncertainties continue lingering, as the crop belt will be gripped by hot and dry weather this week, possibly impacting yield. Now, those are words from a Reuters columnist named Karen Braun. So this is her analysis, not mine. But here is the CBOT net positioning of corn at this time. Money managers increased their net short in this last week to 72,580 contracts from about 26,656 a week earlier. So pretty large. It was already short, but a pretty large selling of corn during the last week. The net long was 16,741 2 weeks earlier. So we moved from a long position to a short position in corn, signaling that managed money is relatively bearish corn, hence why we're probably seeing not as much reaction to the corn market because of the hot, dry weather as we did see the soybeans. This has happened now for a third consecutive week. So yeah, there's definitely a sentiment shift happening in corn. I think traders are looking more at the global picture than at the standalone US picture here. Here's the soybeans as well. So soybeans are still in a long position. They did sell, let's see, what did they sell here? About 15,000 contracts. So the long position shrunk from 50,000 or from 64,000 to about 50,700. So this is the fund's least bullish stance on soybeans. I think that's probably biting them a little bit this morning. However, long position is still a long position. It's just a smaller long position. So it's not like there's any short covering that's going to happen, at least from the managed money in the soybean market, which could mean that we won't see as aggressive a move higher in this weather-driven rally either. So just keep that in mind. Hence why we're looking at the previous high as a bit of a resistance level there. All right, getting into some of the other grains here. Ukraine may use new Black Sea route for grain shipments. Ukraine is considering using its newly tested wartime Black Sea export corridor for grain shipments after other cargo ships follow the first successful evacuation of a vessel on that route last week. Russia has blockaded Ukrainian ports since it's invaded its neighbor in February 22 and threatened to treat all vessels as potential military targets after pulling out of the UN-backed Safe Passage deal. In response, Ukraine announced a humanitarian corridor hugging the sea's western coastline near Romania and Bulgaria. A Hong Kong-flagged container ship stuck in Odessa since the beginning of the conflict did safely travel the route last week. without being fired upon. The Financial Times reported Kyiv was finalizing a scheme with global insurers to cover grain shipments traveling to and from its Black Sea ports, citing Ukraine's deputy economy minister. So there is logistics happening in the region, and it's not a zero as far as moving agriculture crops out of there. Another reason why we maybe aren't seeing the same kind of reaction in wheat that we did in February or in early 2022. Here's what wheat looks like today. We did see it bounce off of support that was put in late April and early May, but it is still kind of flagging near the bottom, and we have a lot of negative technicals on this chart as well. So wheat overall looks weaker. Soybeans are the real winner in this market today. Diesel is pricing in some scarcity with long winter demand looming. At any other time in history, the current state of the global diesel market would have sent some countries into a panic, but all over the world, prices for the fuel are sky high relative to the crude oil which it is made from, pointing to a scarcity that should alarm inflation-obsessed governments. And within just a few months, the Northern Hemisphere will enter winter, pushing up demand for heating as well. The good news is that the market looked even worse this time last year following Russia's invasion of Ukraine, and prices ultimately did come down, helped by a relative mild winter. However, today's shriveled stockpiles mean the world can ill afford any bullish market surprises. Supply curbs can rise at any time, or demand shocks can come from cold weather or surprisingly strong economies. So here's what the diesel futures market looks like. It has run up considerably in the month of July, backed off. It is now testing those highs again. So it's tough to say how much of this bullishness is priced in, but this would affect your diesel prices going forward, and particularly if you need to refill yet for your harvest needs. All right, that is all we have for you today. Have a great day. We will see you again tomorrow.